Hi, this is Scott Martindale with Sabrient Systems with this week's Sector Detector. Lead, follow, or get out of the way. To borrow from American revolutionary Thomas Paine, that's what bulls have been saying to investors lately. They're saying, sorry, no short-term discounts, and don't even try to short this market. The test at S&P 500 level of 1,500 was quickly bought, as I suspected, and now bulls have their sights set on the all-time high of 1,565. And we might see that sooner than you might expect with potential catalysts coming up this week in the form of jobs reports. There's a lot of optimism about those. Bulls love to climb a wall of worry, and we certainly have plenty of that. We have 13 million Americans out of work, and wages for those who are working have been stagnant. Spending power took a hit with the increased payroll tax. Gas prices are sky high. Italy is taking over from Greece as the big threat to European recovery. The world is in an unprecedented currency war. And our elected officials, of course, can't agree on anything long enough to stay out of the way of this slowly improving economy. Nevertheless, the bulls have been undeterred. On the positive side, we've got the Fed and their mortgage-backed securities purchase program. Much of that injection of capital is finding its way into equities. That's not to say equities are being pumped up irrationally, though. Stock valuations are still extremely reasonable from a historical standpoint. And in fact, there's still a substantial risk premium in equities versus bonds, as the cash flow yield is around 7%, and that's now surpassed the average junk bond yield. The average dividend yield among blue chips remains quite high as well. Consumer confidence is relatively muted. The last time that the stock market was at these heights 5 years ago, or actually in October of '07, consumer confidence was sky high, and quite often that means it's going to turn and go down. M&A activity is vibrant, plenty of sideline cash, plenty of corporate cash. In fact, the stocks have been able to stay strong even while the dollar has strengthened, so that's a very positive sign. So the technical picture remains strong, and Sabrient's fundamentals-based sector cast rankings still display a slight bullish bias, even though they continue to have a slow trend towards a defensive stance. If you look at the chart of the spider, I suspected that after that test of 150 that it would bounce and get back into the uptrending channel, and it has done that, in fact. Looking at the sector cast rankings, technology, IYW, remains at the top. It still has an impressive outlook score of 89. Last week it was 94, which is absurdly high. And financial, IYF, comes in second place. Both stocks, both ETFs have low forward PEs and solid support from Wall Street analysts, as well as strong projected long-term growth. At the bottom, we find, again, telecom and consumer services. Overall, this week's rankings have taken a slight defensive turn because after the top two, 3, 4, and 5 slots are all defensive sectors. That's utilities, consumer goods, and healthcare. And that's a little bit worrying on the surface. However, I noticed, looking deeper at the numbers, that the net Wall Street earnings revisions for sectors, it's very minimal. And so it's easy when that happens for one sector to look a little better than another. And so the fluctuations in the rankings can be quite frequent when that happens, and so I'm not too worried about it. Top-ranked stocks from technology and financials: Cognizant Technology Solutions, Qualcomm, the Travelers Companies, and BlackRock. Thanks for listening.